Hi there, this is Kaushik from Tanashvi Fintech. So, given the situation we are in today, thanks to geopolitical disturbances, uh, we can probably look forward to more extended periods of market volatility. Now, since September 2024, the market has really tested all investors. We have not achieved the all-time high reached in September 2024, and we have already crossed 1.5 years. So, we have been receiving many queries from our clients as well as potential clients asking whether they should change their SIPs, whether they should stop their SIPs, whether they should actually maybe book some losses and get out of the market or something like that. Or some people have actually asked whether they should increase their investments during this market. So we thought that we would make three short videos and show some evidence, okay, from periods in the past where markets have behaved much in the same way as they are behaving now. The reasons were different, but we always do, we go back in time and see whether there are patterns which are being repeated or can be repeated. So let's start with Nifty 500 TRI. So Nifty 500 TRI is the overall index of the market. Now this graph, what you're seeing on the screen, there are 3 months mentioned: December 2007, January 2020, and September 2024. These months were the peaks before the market went down and stayed down for quite some time. Uh, from December 2007 till I think somewhere in the middle of 2014, that was like almost more than 7 years. The market did not regain its all-time high at that time of December 2007. In Jan 2020, the market took a nosedive after that because of Corona, but the recovery was sharp and quick. In September 24, the market hit an all-time high, and after that, it has not gone back to those levels now for 1.5 years. So these we will attempt to see when we put SIPs, starting with the peaks, when the market was at its peak, what happens going forward in 1 year, 3 year, and 5 year periods. But before that, let's look at another chart a little bit in detail. This is December 2007 to November 2012. This is a 5 year period. Now, if you notice carefully, on December 2007, this is where December 2007 is, and this is where November 2012 is. In 5 years, the market actually did not reach this level. And in the interim, in 1 year, the market kept falling continuously by a staggering 63%. Then, of course, it recovered and then it went sideways and all. But in 5 years, it did not recover to December 2007 levels. So let's look at what did SIPs do. So, first of all, this conservative, moderate, and aggressive are portfolios which are designed to map to risk profiles of investors. There are three kinds of risk profiles. One is conservative, one is moderate, and one is aggressive. Risk profiling is mandatory nowadays, and it has to be done by you as well as your distributor, and the records have to be maintained. Uh, Now, all three portfolios are made up of varying quantities of debt, equity, and gold. Conservative has the maximum debt, aggressive is the maximum equity, moderate has a balance of all three. Now, if you look closely, you will see that aggressive portfolio had a massive drawdown of 43% in the first year itself. But by the end of 5 years, it had delivered a CAGR of 11%, which I would say is pretty good because the long-term CAGR of Nifty 500 or Nifty 50 is between 12 to 13%. If you look at moderate, the drawdown was less severe in the first year from December 2007, and it actually ended up the 5 year period at a pretty healthy number of 12.05. Even the conservative portfolio delivered 8.5% CAGR in 5 years, which was more than any FDs in the market at the time. So if we look at January 2020, the recovery was very sharp. Hence, you will see that in the first year itself, the aggressive portfolio delivered some 47%. But then obviously the market stabilized and then went sideways. Russia, Ukraine came and all those happened. So obviously, if you see the 5 year CAGR, it's 17% for aggressive and 15% for your moderate portfolios. And these are fantastic numbers. And 8.7% for a conservative portfolio. Again, a very good number for a conservative portfolio. September 2024, we have just spent 1.5 years since then. So we can only show you the 1 year data. Now look at this carefully. The highest delivered portfolio is actually the moderate portfolio, and the lowest delivered is aggressive, because the nature of the portfolio is like that. If you have too much, if you have largely equity, then you will always have a situation where you will have very significant drawdowns followed by bull runs. So that's what's reflecting in the portfolio. So what is the moral of the story? The moral of the story is simple. Risk profile, asset allocation as per risk profile, deployment, monitoring, but fundamentally just follow the rules. You never know what the market will do, how long the market will remain sideways or go down or whatever. It's all beyond our control. What is in our control is disciplined deployment. That's all, nothing else. So hopefully you found this first part interesting and useful. These are our disclaimers for mutual funds. See you in part two. Thank you.